And on today's show, why a medical review is crucial in a life insurance policy review. Part 5 of this week's series on life insurance policy reviews with policy due diligence expert and certified financial planner, Sam Rocke. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, day 5, welcome to the show, Sam.
Thanks, Steve.
Wow, we're done. If you've missed our show, I really exhort you to watch them in sequence. I think you'll get a better learning experience. Watching them in chronology helps the tutorial effort of our educational process. We're talking about a process, we're talking about the medical process, and I don't know about you, when I first came into this business 30 years ago, I did want to sell all product lines, whether it was securities or insurance products. I never thought I'd have to get into human physiology. I was a salesperson, I was a marketeer. I didn't want to get into things like my Chem 24 exam and looking at people's APSs, but it's all part of it. Walk me through the value of your medical discovery call.
Right, so the medical discovery call, we have a team that does these. They're experts in this.
That's all they do.
This is all they do.
Wow.
They're on the phone with clients all day, every day, and what they do is they know the questions to ask that capture 90 to 95% of the insurance underwriting hurdles, the things that statistically are most likely to hang us up in underwriting. They ask all the right questions and they know all of the right follow-up questions. And so in a given interview, it could last anywhere from 20 to 30 minutes, depending on how much the client is engaged with them and likes to gab. And frankly, it's shocking how much clients really open up to this team because
maybe more than their advisor.
Much more than their advisor. And frankly, a lot of advisors say, well, I really don't want to know this about my client, and I don't think they want to tell me. If you take a certain medication or have a certain issue, that's just something you maybe don't want to know about, and you don't want to try to get down into the nitty-gritty details of it.
So this team is going to go through this basic idea. Is it certain questions, or what is it?
Right, so they have a set list of questions that they're going to ask. Typically the way it works is the advisor will get on the phone with the client and with our technician, make the introduction and say and kind of smooth things over, and then the advisor will drop off and it'll just be a very simple, straightforward, open and honest conversation.
How much of the medical process pre-qualifies or eliminates going forward?
90 to 95%. We did a study about 5 to 10 years ago and said, okay, if we ask these questions at the outset, I think it was about 90% of our underwriting issues are what we would call other than applieds would be fixed.
So you're really eliminating a lot of not taken offers, or it was too heavy a substandard rating. You're eliminating a lot of that way up front. So you're really, now I can qualify not only the medical side, but then I can figure out my premium, which is a tolerance test in itself.
It is, and so not only are we getting the rate class right to start, but we're also typically getting the carrier right to start. There are a lot of carriers that have specific niches where they are substantially better than the rest of the market, and so if you don't go there to start, you're going to have to go back and get a new application, or try to sell a client on a much higher premium.
Now this conversation isn't an application, it's not an informal.
Nope.
It's just a medical and you say clients are okay with a third party being introduced into the mix, and talking about, I would think, personal issues.
The very personal issues, and it's actually very shocking that a lot of clients are very willing to open up. They're very open because this is somebody who's relatively anonymous. It's just over the phone, and I can say I know them all personally. They're great people. They're excellent on the phone, excellent at putting people at ease, and they're consummate professionals. And I get nothing but good feedback from that team.
So your medical technicians not only walk through the questions, but now they're asking about prescriptions as well.
Correct. Prescriptions. They ask that you have your basic health information on hand and any medical records or lab results that you might have filed away, because they're going to know what specifics are going to be really important. Diabetes is a major underwriting issue where we can get anywhere from standard or standard plus or preferred all the way down to a decline or highly table rated. And this team knows exactly what questions are going to be pertinent in the underwriting process.
Do you send that out to an advisor so he can see what you're going to talk about, so he feels comfortable with the process?
Right, and typically this is what gets sent out, and it kind of goes line by line of, hey, here's what we're going to talk about. Here are the general things. Here's some things to have ahead of time, so you can kind of coach your client on this and explain to them the value of the call, because it is a little bit of it's a step for the advisor to trust their client to this team, and it's a little bit of a trust level between the client to be able to open up to this person and make sure they're not committing to anything or going to give some of their sensitive information to somebody who's not going to be
I'm curious, just from a client point of view, when you're online, how many clients have their attending physician statement in their own file?
Not very many, for sure, but some of them, if they do have a specific impairment, they'll have their lab results somewhere handy, and so it's probably more common than you'd think, but it's always really good to know ahead of time that that's what they need to have, so that they can have it ready, and so we can get that information and turn it around in a quick
Do you have many clients that actually are proactive? You say to them, could you get that? Do they get their stuff? And do they get their information for you?
Yep, absolutely.
That saves us time and money.
Right. It's a lot easier for a client to go to their doctor and ask than for us to try to go get the authorization and then go to their doctor and ask for it. Typically, the doctor is much more receptive to the client or to their patient asking for the records.
When we come back, we're going to do some market comparisons that I think you're going to find very interesting, and I think you'll find a couple of clients in these examples. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance, designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Welcome back to the second segment. Of course, I'm with Sam Rocke. We are talking about due care process, and right now we're going to speak about a little bit of market comparisons. Walk us through this, because now you're giving us not just a little yin and yang about the client himself, but now we're going to put it against several carriers.
Right. So this is where we finally say, okay, how valuable is your policy compared to what else is on the market? And so we're going to take the scenarios that we looked at in the facts and findings. We're going to start with the as is and do what we would consider to be the best apples to apples comparison, to where we say, okay, let's look at 3 alternative carriers, and let's say let's say we just pay the same premium. Can we get this to last a little bit longer? And so these 3 carriers all last 3 to 4 years longer at the same premium schedule on a guaranteed and projected basis.
Now, when I'm looking at this, what I like about this is you're showing 3. You're not just showing maybe the best, but from a fiduciary market, getting back to Wednesday's show that we did a couple days ago, that would be huge, because now you're offering 3 carriers. It's not just one. It's not your favorite. We're not showing any real favoritism or partiality. We're actually showing, here's our top 3. Right,
and carrier B or carrier C might be a little bit more expensive compared to this carrier, but they're going to be a little better with underwriting too. And we know that there may be a little better fit overall, maybe financial stability, maybe underwriting, maybe just ease of doing business.
Now let's look at this second summary of options, Sam. Walk me through that.
Yep. So this is where we're going to take that second projection we did with John Hancock, where we said, okay, we're going to extend this all the way out, and we're going to see how much it costs. And it was a 50% increase in premium. So we're going to say, all right, well, what happens if our alternative carriers A, B, and C, what happens if we try to extend them all the way out? These carriers can be guaranteed for the insured's lifetime. And they can be done so at a much, much lower premium. It's anywhere from $17,000 to $15,000 a year less. Lifetime to extend out to 121 or lifetime.
So when we're looking through this is now going to a secondary protocol that you have to compare. Now you're multi-dimensional. This is where I think the different facets of the way you look at this. You're looking at it so many angles. You're really covering all the alternatives and variables.
Right. We're trying to give really good points of comparison for the client to say, Okay, how does my policy look in this context? How does my policy look in this context? Because really, we're not quite sure how the client is going to want to look at it. They might say 16 years is good enough.
But we're not asking the client, since they probably don't know,
Right.
and we're not really depending on even the advisor. We've already anticipated preemptively to bring these categories and these areas that we're going to review.
Right. There's a delicate balance there, because you can show way too many options. You can show 4 or 5 or 6 options, and a client will really just get confused. But if you show them 2 or 3 really pertinent options, it gives them a good feel for how this works, for a good feel for how their policy is, and then it starts them thinking to say, okay, I like this, but can we guarantee it to 100, or can we guarantee it to 105? Because I'm willing to take that risk, but I'm not really willing to take the risk that I'm not going to live to 95.
I think this is very interesting, though, because what you're doing is, once we put this policy in force, I think when I'm hearing, this whole week, I hear this is very hard to replace what you're going to put here, because you've already done such, dramatic upgrade in due diligence process.
Right.
This is significant.
Right.
So walk me through basic options again, kind of as a summary statement for our entire week.
So this I think is a really important page to have, and a really important page to get some sort of a signature from the owner or the insured, whoever the case may be, to say, and really we're outlining what we think are 3 or 4 or 2 options for how to maximize this, or maybe you say, look, I don't want to do anything, but what we're trying to do is to help alleviate some of the potential liability by saying, hey, look, we reviewed this, and this is what this is the option that you elected to pursue at the time. You signed, you dated it. So if something were to happen 10 to 15 or 20 years down the road, where a beneficiary comes back and tries to sue the advisor, you can go back and say, look, we had this conversation 20 years ago, and either you couldn't qualify, or you just elected not to do anything, you never got back to us, whatever the case may be. This way, this helps prevent some future issues down the road.
Most clients are okay about signing this?
Absolutely.
Well, that's pretty cool.
Absolutely.
You're just giving them basic options, telling them this is what we're going to do.
Right.
This insulates the advisor's practice against possible litigation by the beneficiaries in the future. This is just good common sense practice when you talk about best practices doing policy reviews.
Right.
Wow. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you next week.